Hey everyone, welcome back. If you want to be a sharper trader or investor, there's one place you should look first every single week: the bond market. Bonds don't lie, they price in growth, inflation, and risk faster than stocks ever do. Today I'm walking you through our bond market analysis system as of April 26, 2026, and exactly what it's telling us about where stocks are headed. This is the no-fluff version you can actually use. First, the current picture. The 10-year Treasury yield is sitting right around 4.3%. That's not screaming panic, but it's also not the super low rate environment we saw a couple of years ago. The curve is mildly steepening, which usually signals the market thinks the Fed will stay patient rather than rush to cut rates. Credit spreads are still extremely tight. That means investors are being paid almost nothing extra to take on corporate risk right now. In plain English, the bond market is saying, everything feels okay, for now. But tight spreads have been a warning sign before big turns in the past. Now the part every stock investor needs to hear: our system's three big scenarios and what they mean for equities. Soft landing is the base case at 42% probability. This is the Goldilocks path. Growth stays decent, inflation cools enough that the Fed doesn't have to slam on the brakes, and stocks can keep grinding higher. In this world you want to own quality growth names and stay invested. Mild stagflation is running a very close second at 43%. This is the scenario that's been gaining ground. It happens if tariffs push prices higher, fiscal deficits keep ballooning, or political pressure forces rates lower while inflation stays sticky. In stagflation, stocks don't crash, but they struggle. Multiples compress, and the winners are usually defensive quality stocks, financials that benefit from higher long-term yields, and hard assets like gold. Recession sits at only 15% right now. The bond market isn't flashing major warning lights on the labor market or credit yet, so a deep downturn isn't the main expectation. Still, we keep it on the radar because if it does hit, stocks would take a serious hit and long bonds would rally hard. So what does all of this mean for your stock portfolio today? The system is telling us to stay neutral overall with a defensive tilt. That means, keep some exposure to mega-cap growth and AI, tech, but don't go all in. Own financials that can benefit from a steeper curve. Hold plenty of high-quality dividend stocks for ballast. Make sure you have a meaningful slice in small caps for rotation potential. And most importantly, keep 13 to 15% of your equity money in a debasement hedge, gold and a small Bitcoin position, because the bond market is pricing in real risks around inflation and dollar strength. Bottom line from the system, the bond market isn't screaming, sell everything, but it's also not giving stocks a clear green light. It's saying stay balanced, keep your powder dry, and be ready for stagflation to become the dominant story if tariffs or fiscal pressures heat up. One practical tip for better trading: every week, glance at the 10-year yield and the spread between investment grade and treasuries. If the 10-year breaks and holds above 4.5% while spreads start to widen, that's your cue to get more defensive. Conversely, if yields fall sharply and spreads stay tight, you can lean a little harder into growth. Bonds are the market's early warning system. Stocks are the loud, emotional crowd. Learn to read the quiet signals first and you'll make far fewer emotional mistakes. That's the current read from the bond market analysis system. If you want the full deep dive framework I use every week, it's pinned in the comments. Drop a comment below. Are you more worried about stagflation or recession right now? Hit like if this helped, subscribe for weekly market updates, and I'll see you in the next one. Stay sharp out there.